We have a great lineup of speakers for you today. I'll start introducing with our moderator today, Gabriel Maureen. Gabriel Maureen is a natural gas pipeline, gas utilities, and MLP senior analyst at Bank of America Merrill Lynch. Maureen, who joined the firm in 2005, currently covers over 80 natural gas pipeline, gas utilities, and MLPs. He publishes an industry weekly entitled The MLP Maven, which addresses industry trends in the energy MLP sector. He ranked first team in the Master Limited Partnership category of the 2010 Institutional Investor All-American Research Team, and has been ranked in the category by II for the last 5 years. He was also the #1 analyst out of 1,806 in the U.S. for overall stock picking in 2009 by the Financial Times Star Mine. Prior to joining Merrill Lynch, Maureen was an associate analyst at J.P. Morgan Securities, where he headed the natural gas equity research team. Our presenters today will start with Judd Krier, Managing Director, Portfolio Manager, and Senior Research Analyst at Swing Capital. Judd has worked as an investment management and equities research focused on the energy sector since 2005, and had previously worked in the consulting engineering field since 1996. Before joining Swing Capital, he spent 3 years as a consulting engineer with Utility Engineering Corporation in the power generation and utilities industries. And prior to that, he worked for 3 years as a project manager with John Zink Company, a COTS Industries company in the petrochemical equipment sector. Moving on to Matthew Cooper, Portfolio Manager of Goldman Sachs Asset Management. Matthew is a Vice President with Goldman Sachs and is a research analyst for the Energy and Infrastructure team. Prior to joining Goldman Sachs in 2013, Matthew worked in the Commodities Origination and Structuring Group at Merrill Lynch beginning in 2011. Between 2007 and 2009, he worked as a research analyst in the private equity group at Lehman Brothers MLP Opportunity Fund. And prior to that, he worked as an investment banker in the Energy and Power Group at Merrill Lynch & Co. Moving on to John Cusick of Miller Howard Investments. John Cusick earned his BA in Finance and Marketing from Temple University and his MBA in Finance from Fordham University of Business in New York City. Cusick spent more than a decade at Oppenheimer & Co. in New York, where he started his career as a junior analyst, working for energy analyst Fidel Gate, and then as a senior research analyst specializing in the midstream sector. Prior to joining Miller Howard, he served as senior vice president and research analyst at Wunderlich Securities in New York, covering energy in North America, including partnerships focused on natural gas, liquids, and exploration and production. His depth of knowledge of the MLP sector is an enormous asset to the firm's portfolio management team. He holds a Series 7, 63, and 8687 licenses. Also with us today, we have Ed Russell, Director of Tortoise Capital. Ed Russell joined Tortoise Capital in 2006. Since joining the firm, Mr. Russell has participated in marketing of all of Tortoise's new closed-end and open-end funds. He served as president of Tortoise Capital Resources from April 2007 to June 2012. Mr. Russell serves as a director for Abraxas Petroleum Corp. Previously, Mr. Russell was a managing director at Stifel Nicholas & Company, where he headed the Energy and Power Group. At Stifel, Mr. Russell was responsible for all energy and power transactions, including all of the debt and equity transactions for the Tortoise funds, starting with the first fund's initial public offering in February 2004. Last but not least, we have Chrissie of ClearBridge Investment. Chris co-manages multiple energy MLP strategies. He has 23 years of investment industry experience. Chris joined ClearBridge in 2006 as a senior research analyst for energy and was named co-director of research in 2009. As a director of research, Chris oversaw the cornerstone of the ClearBridge approach to investing, proprietary research. In 2014, Chris left his role as director of research in order to focus on ClearBridge's rapidly expanding energy MLP sector. Without further ado, I'd like to pass this on again to our moderator, Gabriel Maureen, who will move along with our webinar. If you have any questions, please feel free to jot them in the questions tab, and we'll do our best to answer them during the webinar. Gabriel?
Great. Thank you. Good morning, everyone, and thank you for participating in our webcast. Pleased to be joined by our panelists, and I think today's format will be such that we're going to have each of our panelists discuss some of their views on the MLPs, as well as discuss their firms a little bit for a couple minutes. And then I will ask each of the panelists a question, and then hopefully we'll be able to get to some of your questions as well. So I believe starting today's panel and going through his slides first will be Judd Krier at Swank. So I'll turn it over to Judd.
Okay. Thank you, Gabe. Okay, great. Okay, so we've got a few basic points I'll touch on briefly here, but and this is going to kind of be reflective of some of the questions we've been getting from investors recently. We'll kind of go to the next slide there. Basically, from our view, the basic MLP model, business model, is holding up well. You know, obviously we've had a pullback in the MLP space, driven by the fall in crude oil prices. I think it's also been driven by just general concern and worry about the broader macroeconomy with the current drama with Greece, as well as a lot of volatility in the Chinese markets, pullbacks there, as well as probably you know, concern about an eventual interest rate rise. But I think it's important to note that, in our view, MLP growth has slowed somewhat, is slowing, but it's certainly not disappearing. And I've got some slides we'll go through to kind of address our views on that. And kind of going a bit further, really, all of this is driven, our view of growth is really all driven by the continuing, you know, unfolding of the what we would call the energy renaissance that's going on in North America, driven by shales and the advances of technology in that regard. This is driving kind of a replumbing of North America and repositioning of U.S. energy assets across the country. We believe there's many years of running room in that regard as well. So if we can jump to the next slide, please. So kind of going back to the question about is there growth? Is there any growth left? And I think the answer to that is certainly there is. And as you can see by this chart, there's a very wide dispersion of yields, as well as distribution growth outlook across the space. You have some MLPs are growing rapidly, while others are growing very slowly or hardly at all, and you can see the spread in yield because of that. But again, we want to reiterate, we still believe there's a lot of growth ahead of us in the MLP asset class. I think if we can go to maybe the next slide, we could kind of see some of the disconnect that we talked about in pricing. Basically, since about last fall, where you started to see crude prices coming down, we've seen the MLP market pull back in a similar fashion. It's kind of been, you know, in fits and starts since that time. But I want to highlight in this chart the kind of the blue background there. That is the median distribution increases across the MLP asset class, and as you can see, there's still a growing level of distribution through that period that we've seen that pullback in the MLP unit prices, but we've still seen distributions grow, and that's where we're seeing the big disconnect. That it, in our view, is probably an over discounting of future growth being a little bit slower, and we think it's disconnected from where we should be trading. Arguably, for a lot of reasons that are out there in the market right now, Greece and other things. But we think once we kind of get through some of these issues, we should see MLPs respond accordingly to the underlying viability of the underlying businesses, which are doing actually quite well. Maybe we can go to the next slide. we can kind of see where this growth is coming from, kind of alluding to the earlier comment about replumbing of and repositioning of North American energy assets. We're finding more and more hydrocarbons available to come to market at lower and lower prices, and they're just in parts of the country where either the infrastructure that's there doesn't quite fit the need, or there just simply isn't infrastructure there, and so new infrastructure needs to be built to connect those energy sources with the markets that are needing to use them. LNG is a great example. There's a lot of progress being made there, and over the next several years we're going to see more and more LNG liquefaction plants start up, and therefore are going to need the infrastructure to supply them. If we can go to the next slide, please. I think another great example of where we're seeing the need for growth or the need for infrastructure and repositioning infrastructure, certainly in the Northeast, driven by the Marcellus and the Utica shale plays. Here you can see these are gas pipeline capacity additions out through the next 3 years, and those numbers are in BCF or billion cubic feet per day. So you can see large amounts of flows moving out of that area, and in a lot of cases needing to go in opposite directions of the way that they've gone historically. Turning to the next slide. Again, this is kind of moving hydrocarbons, moving gas in a different way than it historically has flowed, and that's again driven by the vast amount of resource we found in the Marcellus, and as that resource comes online, it is a very economic resource, and it competes against other resources coming from other parts of the country, and what we're finding is more and more of it is headed south, and therefore you see a large need for infrastructure to move that gas south, where it will be connected to LNG export facilities over the next several years. And then the last slide I'll touch on is we've talked about natural gas. Now we'll kind of talk about crude oil. Again, a lot of room to run here as crude oil pipeline capacity needs to expand or reposition to move the hydrocarbons to where the demand centers are. And so that's kind of a quick overview of where we see the growth potential and what we see unfolding over the next several years for the MLP asset class. And I think with that, I'll turn it over to the next speaker.
Great, thanks, Matt. Why don't you go ahead?
Okay, great. Thanks, everyone. This is Matthew Cooper at Goldman. If you could, I guess, go to slide labeled number 4 for me, the bar charts, that'd be great. The prior 3 are just disclosures. Are we there, Gabe?
Yes, we are.
Okay, thanks. So, you know, I think first off, it's important for everyone just to remind everyone about, you know, what MLPs are and how, I guess, you know, they are energy and they are infrastructure investments, but they are supposed to be a bit lower volatility than the producers. So what we're trying to show here is, you know, since the crude peak, which was last June, the energy producers, as represented by the S&P index here, is off almost 30% as of the end of May, while the energy infrastructure index, as represented by the Illyrian, is off about 9.5% on a total return basis. So it has been relatively well performing in the energy space, a lower volatility strategy. Now, I will tell you, everyone, this is as of the end of May data, and June has not been kind to the energy infrastructure index. It's off over 7% for the month, which we think is in large part due to the continued weakness in NGL prices that has been really hurt a lot of the performance of some of the gathering and processing names. But it's still important to understand that this is a lower volatility strategy that, although has some correlation to crude oil and natural gas, it is a less risky way to play this energy renaissance that the prior speaker mentioned earlier. And you can also see, I think, the benefit on the right side of the energy, so-called energy users or refiners, the chemicals, utilities that have had positive performance since as their feedstock costs have come down over time. If you just go to the next page, please. Here, I think it's important, as the prior speaker also mentioned, we have this market pricing in at these levels, basically very low single digits, almost no distribution growth. We think that is not the case. We do think there is mid-single to high single-digit distribution growth over the next several years in this market, and our assumptions and our projections are based on this idea that you've seen over 4 million barrels a day of production growth, crude production growth in the U.S. in the last 6 years. That is the reason, or one of the main reasons, that crude prices have collapsed. And in order to keep prices at these levels, i.e. low, we're going to need to increase supply more. What do we think will happen more likely is prices will start to come back up as crude production begins to weaken sometime in the second half of this year. Rigs will come back, production growth will resume, the need for energy infrastructure will resume, and MLPs will begin investing or continue investing. Distribution growth will continue, and although it will not be at the levels that I think we've seen over the last, in 2014, of double digit, but perhaps number somewhere in the 2011-2012 range of 6 to 8% is a realistic number, we think, over the next 3 to 5 years. Also, I just would like to point out that if you look in the top chart there, we do think the spread is to treasuries this year, in this case the 10-year treasury rate, is outside the historical average going back to June 2006. It's not a huge difference compared to where the historical average is, but we do think it is outside it. Important to realize those numbers do include the period of time in 2008 and early 2009 when that spread blew out to 18, or excuse me, not 18, mid-teen type return spread to treasuries. So if you look at it just over the last 3 to 4 years, we are well outside the historical spread to the 10-year treasury. And then just quickly, I'll cover a little bit about the 2 closed-end funds we have and as ways to invest in the MLP space. We have the Goldman Income Opportunities Fund, GMZ, which is more midstream focused, and was launched in September of 2013. And then we have the Goldman Sachs GS MLP and Energy Renaissance Fund, which we launched last October, a little bit more diversified, more upstream and downstream exposure, a bit higher yield, but both ways to play a levered play on the MLP space. Thank you.
Great. Thanks, Matt. Appreciate it. And I think I'm going to turn it over to John next.
Thanks, Gabe. And good day, everyone. So we sort of agree with the previous 2 presenters that there has been volatility in the MLP space over sort of the last few quarters here that you would normally not see, and we would point out, besides the large macro factors affecting the overall economy, we think a lot of the volatility is linked to concerns about oil prices and more recently about natural gas liquid prices. However, what we like to point out is that most midstream MLPs have indirect commodity price exposure. Therefore, commodity prices do not generally have a big impact on cash flows. We do believe volatility could continue to remain a bit higher than we've seen in the past due, again, to the near-term uncertainty surrounding commodity prices. However, we believe the need for transportation and storage infrastructure remains largely unchanged. And we believe there are many avenues for continuing growth for the MLP sector. And I'd like to point out some of those avenues of growth that we believe are in place. One, we expect MLPs to be the leaders in the continued build-out of U.S. energy infrastructure by targeting oil and natural gas shale plays, specifically the Eagle Ford and Marcellus, Utica, Bakken, and Permian plays. We believe MLPs are uniquely positioned because of their lower cost of capital and years of expertise to be at the forefront of the midstream build-out. Number two, U.S. power generation markets should drive natural gas demand growth, particularly in the U.S. Southeast and Northeast markets, because of increased consumption and the retirement of coal plants. Three, as we speak to the management teams of the companies that we invest in, we continue to hear feedback about the build-out of pipelines to Mexico for exports, and we think that will be a growing trend going forward. So we think that is another avenue of growth for energy midstream assets. Four, LNG exports should drive further demand for natural gas infrastructure. And we believe it will benefit many companies, even in those not directly involved in those export facilities, but it should benefit natural gas transportation and storage companies as the commodity needs to reach those export terminals. And lastly, the U.S. has become a larger exporter of refined petroleum products, including gasoline, diesel, and jet fuel. And we believe that will be a continuing story for MLPs and for energy infrastructure assets. And so we view those 5 reasons and avenues of growth to continue. Despite the weakness in commodity prices, you don't see a lot of change in the plans of the MLPs as far as CapEx. Now, some projects may be deferred at this point and put off a little bit, maybe a few quarters down the road, but we believe the long-term story generally has not changed all that much. And we also believe that solid distribution increases that you typically see from midstream companies will continue for the foreseeable future. And kind of the second topic that I wanted to talk about, and we've been getting a lot of questions on, is recent consolidation in the midstream sector, and really specifically the general partner, limited partner consolidations that we have seen over the last year. Again, we've seen a number of deals kind of starting with the Kinder family consolidation, continuing with the 2 Crestwood entities merging, and now potentially Williams involved in a transaction. So again, we've seen a number of deals where there have been consolidation, but we think there's really some specific reasons behind those deals, and the primary reason being the higher cost of capital at the underlying MLPs. And because of this higher cost of capital at some of the MLPs, that will likely result in current or potentially future slower distribution growth from those entities with the higher cost of capital. However, most MLPs are not burdened with high incentive distribution rates currently, which we believe is the main culprit behind the higher cost of capital. And therefore, again, we think it's very specific to a few of the names in the space, but that the distribution growth that we have seen historically will continue in those names with a lower cost of capital and with names that do not have incentive distribution rights, specifically the names without general partners who have an economic interest in the underlying MLPs. So while we believe we may see a few more of these deals because of this higher cost of capital issue going forward, we do not think the general partner, limited partner consolidations that we have seen will continue as a big trend in the sector. Again, maybe a few deals over the next couple of years going forward, but we do not view it as a big trend right now. And with that, I'll turn it back over to Gabe.
Great. Thanks, John. I believe Ed is up next.
Yeah, in the interest of time and so we can get to the Q&A, I'll just go ahead and give you a brief overview of the firm. If you could back up on the slides. There you go. So we're, no, okay, I think you got it now. Tortoise manages about $18 billion in assets, all of it under the energy value chain, with a majority of it in the midstream sector. We have both closed-end funds and open-end funds, and starting just this morning, we launched our first ETF that's dedicated to the pipeline sector through Tortoise Index Solutions. So that was just announced today. If you could advance to the next slide, we'll kind of focus today, highlight our Tortoise Select Opportunity Fund. That fund provides access to North American energy companies and their beneficiaries that Tortoise believes will benefit from changing dynamics and catalysts, which would include supply-demand imbalances or price differentials or restructuring. And if you go to the next slide, we do that through a tactical approach, which is slightly different than our other funds that are kind of buy and hold with our long-term commitments. Here we'll move in and out of the sectors with, we'll have 15 to 40 holdings all the way across the energy value chain, so midstream, upstream, or downstream, with allocations, 0 to 50% for midstream and upstream, and then will be 0 to 30 for some of the major other areas in the downstream sector, which would include refineries or oil field services or petrochemical companies. Firms up even after the recent volatility, about 6.6% year to date, and it has about $40 million under in assets under management or a mutual fund sector, with all three of our mutual funds combined being about $2.2 billion, with most of that in our midstream fund, the Tortoise MLP and Pipeline Fund. So with that, I'll turn it over to the next speaker.
Okay, great. Thanks, Ed. And now we will turn it over to Chris.
Good morning, everyone, and thank you for your time. I'll also be very brief as well so we can get to the Q&A. Just by way of background, looking at our first slide, ClearBridge is a wholly owned affiliate of Legg Mason. We are their largest equity manager with around $118 billion in assets under management, which also includes roughly $9 billion in our MLP funds, 4 closed-end funds, and 2 open-end funds that we manage here at ClearBridge. ClearBridge, just by way of, again, by background, while our name is relatively new, we actually were rebranded in 2005. Our heritage actually dates back to the 1960s. We are the old Solomon Brothers Asset Management, the old Smith Barney Asset Management, and in 2005, Citigroup exited the asset management business, sold that division to Legg Mason, and Legg Mason rebranded the unit as ClearBridge Investments. Moving on to the next slide, we do have 4 closed-end funds as well as a couple open-end funds. Just very quickly, we launched our first closed-end fund in 2010. That was CEM as the ticker. That fund today has around $3.2 billion in assets. The following June, we launched EMO. That is a fund that's focused on crude oil and natural gas liquids infrastructure. That fund has around $1 billion in assets. The following June, we launched the ClearBridge Energy Total Return Fund. This is a tactical fund structured to maximize the current yield and growth in yield over time. That fund is also a little in excess of $1 billion. And then finally, 2 years ago, we launched the ClearBridge American Energy Fund, CBA, and that fund is focused on natural gas infrastructure. And much like the previous 2, this fund is a little north of $1 billion in assets under management. Moving on to the next slide, and this is true for all 4 of the closed-end funds that we manage. From a philosophical point of view, we are very focused on the midstream part of the energy value chain. We do not invest in the upstream companies, and we do not invest in the downstream companies. And the key reason for that is we are actively trying to limit commodity price exposure. Certainly, there's something to be said for owning upstream MLPs at certain points in the cycle. But in our view, the biggest benefit of the midstream sector is the stability and predictability of cash flows. And by introducing commodity price volatility by owning upstream or downstream companies, we think we're mitigating, if not eliminating, that benefit of the asset class. We have kind of a boring strategy here, and that's kind of by design. We're owning assets that are backed up by long-term contracts, fee-based business models, government-regulated assets. And while these assets may be a bit boring, they do generate very stable and predictable cash flows over time. We also like companies that have strong balance sheets. This is a very capital-intensive business, and it's imperative that we have a good understanding of where balance sheets are today and where they will be going forward, as these companies are required to finance all the growth prospects that they have. And with that, I will stop and turn it back over to Gabe so we can do some Q&A.
Awesome. Thanks, Chris, and thanks, everyone, for the comments. I think maybe we'll go on reverse order here in terms of going to the Q&A. And I am, excuse me, privy to some of the questions that you've been submitting on the webinar. And for those of you that want to submit questions, please do so. So I think I'll start with questions maybe for Chris and Ed first. We did get a question about how specifically you manage leverage within the closed-end funds and that approach essentially. So maybe if you can kind of talk about that, and I guess there's also sort of that decision in terms of using leverage within the closed-end funds, whether to kind of go with floating rates on leverage,
right,
or to try to lock in your rates.
This is Chris. I mean, it is what we do. All these closed-end funds do employ leverage to varying degrees. We think we have implemented a level of leverage that is conservative and manageable, and the key is to keep that leverage at a level such that if we do have a downturn in the MLP space like we've experienced over the last 10 to 12 months, that you don't bump up against the SEC maximums of 33%. And we actively watch those leverage levels in all four of the funds that we manage. I think very importantly, as mentioned, there's two ways to implement this leverage. You can implement it with a line of credit with a bank, which is very often, if not always, floating rate interest. That's a risk. You can also term out the debt, which comes at a higher cost, but it eliminates that risk of rising interest rates, limiting the fund's ability to pay out the distributions that we expect to pay out. When you look at all four of our funds, over the course of the last 2 to 3 years, we've actually termed out 80 to 90% of our debt financing with long-term paper. These were all AAA rated bonds that we sold largely into the insurance market, and these have an average duration of roughly 8 years.
Thanks, Chris. Ed, do you want to also comment?
Yeah, sure. Well, I can, I agree with Chris there, as we have a similar philosophy, just, a little bit more specifically. We also, agree that you want to have debt levels at a manageable level in today's environment, and remember the lessons that we learned in 2008 and 2009. Right now, our leverage as a percentage of total assets, kind of on average, is in 23 to 25%, and we also use the same strategy of trying to use laddered maturities so that we're not bumping our distribution on the backs of low interest rate environment. So we have about 80% of our debt on a fixed rate basis, and I think that's important for clients to look at, is to really dig into any closed-end fund that you would choose and see how much interest rate exposure that they do have. I've been on panels with other closed-end fund managers outside of the MLP space, so no one here on the call, and they are actively looking to float a lot of their debt to take advantage of these low rates, and we just couldn't disagree more, and I think that'd be consistent with a lot of people on this panel, is that we don't need to have low interest rates to provide attractive distributions in the MLP space.
Great, thanks, Ed. And maybe turning to fundamental questions, and then to John, in terms of, you mentioned the GP LP transactions that either have occurred or that are pending potentially in the market. Can you discuss, John, how you've perceived MLP access to capital? As everyone should hopefully be aware, considering MLPs pay out a decent portion, if not most, of their cash flow in the form of distributions, access to capital markets has always been crucial. So can you just talk about kind of what you're seeing out there, both on the debt and equity markets?
Yeah, sure. Thanks, Gabe. The way we view it is that it doesn't appear that there's been much change as far as access to capital for the MLPs recently. We continue to see them place debt at very attractive rates, especially given that they're going to take those funds and put them back into building assets that are going to throw off very nice rates of return. So we think the spread there is still very attractive. And even if interest rates were to increase, we would say it's probably going to increase just gradually and won't have a big impact on MLPs over the long term, and the borrowing costs are likely to be passed along to those users of the pipelines and storage facilities. So on the debt side, we have not seen a lot of change. On the equity side, we still think there's a lot of demand for equity from the MLPs. Their yields are still attractive relative to other interest-bearing vehicles. And so we think investors still would like the equity in MLPs. Perhaps, given the pullback in the space, some of the management teams might be a little bit prudent and may not want to issue equity at this point until unit prices firm up a little bit. But we still see a real desire out there for both for equity and good placement of debt from the MLPs.
Great, thanks, John. And then Matt, if we can maybe talk a little bit about kind of commodity exposure, and your slides try to, I think, distinguish between MLPs and other areas of sort of the energy world. Can I think you talk about maybe incrementally speaking, I think there's been a lot of MLPs that have tried to, I guess, go more fee-based even during this commodity downdraft, and what you're hearing from some management teams about trying to, I guess, get even less direct commodity exposure. And then as a second question, certainly we've gotten this question a lot over the last 6 to 12 months with the commodity price downdraft. To what extent, you're concerned about MLP exposure to, let's call it, producers that might be a little bit more distressed in a low commodity price environment? Where do you think that should be a concern for MLP investors?
Sure. So, yeah, I think you've seen, we've certainly seen a lot of MLP management teams out there actively striving. I think even before crude oil prices really started to collapse, trying to get more fee-based or at least volumetric-based with MVCs or minimum volume commitments, if possible, contracts, as opposed to some of the more commodity-sensitive ones, i.e. like a percent of proceeds contract where they basically get paid in NGLs, or a keep whole contract where they have an exposure to the difference between NGL prices and natural gas prices. I think management teams were having some reasonable success doing that, but I think it's also important to understand that in a place that's been a very big growth area like West Texas and the Permian, there has still and it continues to be a very large E&P producer preference for the MLPs taking some commodity price risk through like a percent of proceeds type contract. And I think it's important to just acknowledge that that's been a reason. I think a lot of there has been some revenue hits to a lot of the guys who have operations out there, a lot of the gatherer processors. I'm not talking about guys who have long haul crude pipelines delivering crude, delivering gas or NGLs from West Texas, but rather the guys that are gatherer processors in the basin who still had a lot of that exposure subject to those sorts of contracts. In regards to exposure to distressed producers, I think it's an issue that several companies are grappling with. The most notable, I think, perhaps being Crestwood and the Quicksilver situation in the Barnett. Most of the management teams, when you talk to them, they say, look, even in a bankruptcy reorganization situation, the thing that keeps the wheels turning and the bankruptcy process going is the gas or the oil or whatever the product is flowing. And we are the vendor that allows them to do that, so we are a key vendor, or different terms, but basically the idea being that we will have to continue to get paid by the bankruptcy court because without us, we can turn off their flow, their cash flow dries up, and that's a major problem. So at least so far, I think most of the management teams you talk with and what they're dealing with is they still feel very good that even if the companies they're exposed to were to have some of these issues, at least they would continue to be paid because they're such a vital part of the cash flow structure, and even in a reorganization, without their pipelines or without their gas processing, everything would come to a stop. So they're a vital vendor, as you say.
Right. Great. Thanks, Matt. Makes sense. And then, Judd, you had a bunch of slides and could probably choose from a couple of them, but maybe if I can ask about kind of the export trend, and I think the opportunity set's still there. Clearly, there's been a lot of press lately over the last couple months over the U.S. revising its crude oil export policy, and as many on the webinar likely know, crude oil exports by and large are currently illegal by U.S. law. So I guess first, maybe if you can tackle the fact of whether you think that potentially changes, and then how you think MLPs could potentially be positioned for a change in crude oil export law.
Okay, sure. Yeah, I guess to bring everyone up to speed, you know, the U.S. does have laws in place that don't allow us to export crude oil specifically, but you know, it's also notable that we can currently export nearly every other energy commodity that we see out there, and that ranges from NGLs, propane, butane, and then now we've even got ethane exports that are kind of about to begin soon. Obviously, natural gas, LNG, and certainly refined products. So all of those are already readily exportable, and what we've seen is a large amount of growth in that area, specifically for MLPs that provide the infrastructure, the terminals, the ports, the pipelines, the processing that enables the export of all those products. Now, specifically on crude oil, there's been a lot more talk, a lot more discussion, a lot more negotiation, much more in the you know, political and regulatory framework about, okay, what we now have growing crude oil production in this country for the first time in a long time, and it's steady growth. It looks very sustainable. It looks like this is going to be a long-term issue that we'll have to deal with. And as we grow exports and as we grow domestic oil production, we've already been displacing imports of certain types of crude oils, and I think that trend will continue, and so we're going to have to see more and more discussion and debate about, does it make sense to now allow direct export of crude oil or kind of unrefined crude oil to the international market. And I would say our view on that is that we've been seeing a lot of positive steps being made towards that eventual end. And I guess I would cite where you've seen certain producers get kind of one-off approval to export condensate, which is a very light type of crude oil, if you want to call it that, with very, very minimal processing. And so they've been able to export you know, fairly significant volumes, but it's kind of been in a one-off framework. And I think, you know, we kind of view that as a way for regulators and government to kind of test the waters to see how this works in reality if we start to allow exports. But again, I would say the conversations, the discussions, the way that the industry seems to be headed, and in our discussions with management teams that are kind of on the forefront of this, the things are moving in a very positive direction. So I think we could certainly see more and more expanded ability to export crude oil over the years to come. And I guess the second part of that question is, how does that impact MLPs? I think it's, you know, I think we're just on the cusp of seeing that. If we started to export crude oil in a meaningful way, there's a host of different MLPs that will be impacted by that. You know, not just from the ports where they're actually loading vessels and things, but it's all the other kind of infrastructure along the value chain, all the way back up to the producers that could benefit from that and from growth in that market, which is currently really, I would say, not baked in or not factored into the growth of the MLP space at all, in our view, right here.
Got it. Thanks, Judd. And then I'm going to take a question from that we got submitted, and I'm going to read it verbatim and then maybe also add my own little addendum to it. Question is, how would each of the panelists time the adding of fresh capital to the MLP sector, knowing that they would have a knowing that basically most of the panelists would essentially say you really can't time the market per se. And I guess kind of related to that, which is my own addendum, which is to say sort of what is the catalyst that's going to be getting us out of the rut of MLP performance over the last couple of months. The commodity prices, is it interest rates, is it a slowdown in MLP equity issuance? Just curious on the panelists' thoughts, and maybe I'll throw it out to Chris to start.
Sure. I mean, as far as timing, I think the question's right. I think timing this can ultimately become a fool's game. And our view, and certainly the way we manage the portfolios, is that these are long-term investments. And certainly our strategies, all of them, have very low turnover. As it pertains to catalyst, I mean, I've been saying for 3 or 4 months now that we really needed to see 3 things. From a sentiment perspective, not from a fundamental or cash flow perspective, but from a sentiment perspective, we needed to see flat, if not increasing oil prices. And obviously we've seen that as oil has moved off its lows of 43 to 58, 59, wherever it is this morning. Secondly, investors needed assurance that we were not going to see distribution cuts from our portfolio holdings. I can't tell you how many advisors I've talked to over the last few months who have asked me which of our holdings should we expect to see distribution cuts, and the answer was and continues to be none. And as we work more time off the clock and people start to get comfortable with that dynamic, I think that will help investors change their sentiment towards the group. And then finally, I think that investors needed reassurance that if there weren't going to be any cuts, that the growth story was going to remain intact. And several of the panelists mentioned in their introductory comments that growth is still going to happen. I couldn't agree more. And as we've just recently finished first quarter earnings season, if you look at the names that I'm following, which is pretty much everything exclusive of the upstream companies, the year-over-year distribution growth rate on an unmarket cap weighted basis, just a straight average, was in excess of 11%. And I'm only looking for 8% growth for the year, so certainly we got off to a good start. My 8% number for the year certainly looks attainable, and perhaps it's going to be conservative. But as investors understand that the growth story is still there, I think we're well positioned for the second half of the year. Outside of any sort of major global capital markets issue like we're experiencing this week with Greece, again, I think these stocks look like they're well positioned for the second half of the year.
Thanks, Chris. Maybe I'll just turn it over to the general panel, see if anybody wants to add anything to Chris's remarks.
Yeah, Ed, if I could, first of all, I agree with Chris's remarks, and I'll just add to those. Is I think that when you look at kind of how you should be adding additional capital, certainly you would expect all of us to say that these are appropriate assets for most people's portfolio, and that you would want to be a long-term investor in it. But I really do believe that investors that will continue to reinvest at these levels are going to be able to get better than the average returns in the long run. I mean, we are seeing historically large discounts to net asset value in these closed-end funds. And I think that eventually, I certainly hope that someday we'll get back to what we experienced, and many of us experienced it a few years ago, is where they would trade at or a slight premium to NAV on average. But if we can even improve this discount back to what the averages were last year or the year before, investors could do very well, reinvesting at these levels using closed-end funds. So I do believe, however, that they should also be aware that we could see a little bit of additional commodity price volatility, and we could see some evidence of rising interest rates that, although do not have a direct effect in the MLP sector, have historically been had a short-term effect on prices. But if you can overlook that, I think you can get better than average returns on a long-term basis.
Thanks, Ed. Don't know if anyone else wants to chime in on that, but I think The other big question we're obviously getting is around interest rates, and I know some of the panelists have kind of commented on that, but I don't know if, you know, John or Matt, if you guys want to talk about what you think the market is discounting currently from an interest rate perspective. Clearly, I think a lot of MLP investors, you know, and analysts, including myself, think the market's discounting much higher interest rates than we've got currently in terms of where MLPs are trading. So I don't know if there's anything you want to chime in on that, Matt.
Yeah, this is Matt. You know, or go ahead, John. I'm sorry.
Go ahead, Matt. Go ahead. I'll follow up. Go ahead.
Yeah, I think we would agree with you, Gabe, that the market is pricing in something markedly higher than the, call it, you know, 2.4% 10-year Treasury. That's the yield we tend to focus on for a risk-free rate. You know, where that is exactly, probably we were somewhere in the 3.5% type of range when we think about a historical relationship. I said earlier we're about 25 basis points outside of the last 10 years. You know, it's important, I think, to understand though that a very large portion of that is because I was quoting Illyrian is dependent on some of the largest holdings there. But you know, long-winded way of saying I do think you're talking about 7,500 basis points higher risk-free rate being priced into this market. And I think especially when you see about, you know, how MLPs have traded in relation to the 10-year, perhaps in comparison to a utility or a REIT index, you know, the other kind of equity but yield-oriented asset classes out there, and you see the performance for MLPs versus those indices. Thank you.
Great. John, do you want to follow up or?
Yeah, I'll just kind of give a quick follow-up on our view that we would, I think, point to if they start to increase rates, we kind of ask ourselves, why are they increasing rates? And they don't want the economy to maybe overheat, perhaps. But we think, you know, if they do increase rates, it's because the economy is doing better. Some of the numbers coming back are positive, and we think a good economy is always good for energy consumption, which will ultimately benefit the MLP. So we don't, you know, while higher rates, you know, generally are benign for MLPs in the long term, it seems in the short term it does rile the sector a little bit, but we do think in the long term increased energy demand will be good for them. And we also would point out, again, on a relative basis, that the yield of MLPs are very attractive versus fixed income instruments. And also the MLPs offer one thing that fixed income can never offer, and that is the distribution growth. And so the growth of income we think is very important. And so we look to the midstream MLPs, and we have confidence that they will continue to grow the distributions. And that is one thing I think that really offsets higher rates.
Got it. Thanks, John. Great. I think that about wraps up the time we've got for the webinar. So I think first of all, I want to thank all our panelists for their insightful comments this morning. I want to thank everyone for their participation and listening in, and hopefully everyone found it helpful. So thanks to everyone, and hopefully we'll be talking again with some better MLP performance in the future.